Over to you, Alex.
Thanks, Simon. I'll start sharing my screen now. So, good morning, everyone. Hope you're all well. This is the third presentation that I've done to Hurst. Thank you for asking me to speak again. It's also the third since we've been in lockdown as well. So, fun and games. I hope you're all keeping well in this very weird time. And I've never done a presentation to a baby before, so I think we're all hitting some firsts today. So, thank you very much, Keith, for bringing the little one along as well. So just what we're going to go through today, I'll give you a quick introduction to Luna so you can understand who we are and what we do. I'll give an update on the UK economy to begin with, but increasingly, and just as important, it's important to see what's going on in a global context as well. The UK economy isn't, well, despite the fact we're on an island, is impacted by global events, and the UK stock market, 70% of the earnings that go into the FTSE 100 are derived from overseas. So from an investment perspective, it's just as important that we concentrate on what's going on globally. There's been significant amount of policy proposals, schemes, movements by central banks over the course of the last year since the pandemic started. We'll just talk about some of the consequences of those policy response. There's one extremely important one. As an investor, and I thought you might be interested in this as well, is what does this mean in terms of equity market valuations, fixed income valuations, etc. as well. So I'll just give you a bit of an update on that, and we'll finish with some conclusions. And if we can keep questions to the end, and as Simon mentioned, if you do have anything that you want to ask, please feel free to use the chat function, and we'll try and get to it as we're going through. So over to who Luna are. We started trading last March. We took our first client on in June. So we're a relatively new discretionary management firm based in Manchester. It was an interesting experience starting a business in lockdown. Whilst the business might be relatively new, myself and my colleagues have been in the industry for a number of years. We've got 150 years combined experience. And what do? We offer discretionary bespoke portfolios for different risk profiles. We manage portfolios on external platforms like Standard Life and Aviva. We also offer an AIM portfolio service where you buy individual AIM companies that qualify for business property relief, which means they're outside your estate for inheritance tax planning after 2 years. So we offer a number of discretionary different portfolio services. Despite the fact that we're brand new, we've grown to a team of 10. I was just telling Simon before the call, it's been a fantastic start for the business, despite the fact that we have been starting lockdown, and signed paperwork and assets under management is now at 250 million. So we've been able to grow significantly in a very short period of time, which has been great. That being said, our pipeline is still very strong, and on top of that, we're still growing in terms of new recruits that will be joining through the course of this year as well. Now, enough of what about us. Let's go on to the body of the presentation. So 2020 or 2021, I think we can all agree that 2021 has started in a very similar frame to 2020. Let's start with the obvious. The number of COVID-19 infection rates in the UK and globally is really starting to accelerate, which has got significant consequences in terms of, sadly, the number of people in hospital and also the people that are dying. And because of that, the government have to act and respond to increase the restrictions that we have. And it's not just happening in the UK, this is very much happening in a global context. This lockdown is slightly different to the other lockdowns that have been. In March, it was probably the most severe that we saw. In November, it wasn't really a lockdown in my view. It was quite mild compared to what we saw in March. But in January, February, things are going to be back to what we saw in March. But there is this time light at the end of the tunnel, and that light at the end of the tunnel is clearly the vaccine program, which is being deployed. And this is positive. This is an extremely positive development that we've seen in a very short period of time. The first vaccine was announced in November. They've now been approved by the UK, all 3 vaccines. And the crucial one from a UK perspective is the Astra Oxford vaccine because we bought so many more of them compared to the other vaccines. So it is a positive. Clearly, the government are in the process of ramping up the vaccination program as well, so we can vaccinate the most vulnerable as quickly as possible. And that's key, and that's key for the way that we live, but it's also key for the economy as well, because that means that restrictions will start to ease. Sorry, so, do you mind just going back onto mute quickly? Sorry, just a bit of background noise and feedback. So as the vaccination program rolls out through the course of this year, restrictions will start to lift and the economy will start to accelerate. And we'll touch on it later, but we're actually very optimistic about what the economy and the stock market can do for the course of the next few years because of this factor. Now, some things, thankfully, were left in 2020. There's clearly a few teething issues that are going on at the moment with regard to Brexit. But this has been 4.5 years of hanging over us since the referendum. It's amazing that it's actually happened for that length of time in hindsight. And it's had significant impacts to the economy. Before the referendum, the UK was actually one of the fastest growing nations in the G10. Now, clearly, we're going through a period of negative growth at the moment because of COVID, but the UK economy was already slowing into 2018 and 2019 because of the impact of Brexit. As well as that, from an investment perspective, it's been a very easy decision for overseas investors to shun, to ignore, to not invest in the UK over the last 4.5 years, because they've always had that question on the back of the lips of, well, what about Brexit? What's going to happen? So it's extremely positive that trade negotiations have now been agreed. There's still going to be bumps in the road. There's still things that are going to be ironed out, but at least we can now start to look forward. And from an investment perspective, I think you can start to see overseas investors getting significant more confidence about allocating to the UK again, which is a positive. Now, it's clearly a lot going on in the US as well at the moment with regard to the inauguration, which is happening next Wednesday. I think you'll all agree that Donald Trump has agreed to go quietly. But it's clearly causing some short-term volatility and unrest within the US at the moment, which is having a short-term impact onto markets. We must look longer term. We're a week away now from the inauguration, and hostilities over in the US could likely continue, particularly next Wednesday when Biden is made the US president. But let's not get too over concerned about the short term. The Trump policy, the Trump reign, has been interesting to say the least. From our perspective, we're seeing this as a positive change. Less trade negotiations with China, or less hostile trade negotiations with China, that plunged the global economy and global stock markets into negative territory in 2018. It's likely under this administration things are going to be more constructive and working together more, which is a positive. That being said, I don't think you can undo what has been done with regard to US-China relations, and things are strained and will continue to be strained. And I don't think the US administration are going to rein back any of the policies that have been introduced over the last few years. Just staying in the US, and it's not just the US, it's happening globally. You've seen a big fiscal stimulus in terms of billions of dollars, that have been spent to stimulate the US economy from the worst impacts of COVID. And you're starting to see that hitting bank accounts of Americans now. So that is going to have a positive impact through 2021 as well, as that money looks to get spent. Now, I'm going to go over and just give a quick update on the UK economy now. So this is quarterly economic growth, and it goes all the way back to 1955. And you can see we've had a relatively quiet 70, 80 years or so where things basically stayed in a nice range of -2% to +5%. And then 2020 happened, and you can see how extreme the economic impact was in 2020. Q1 was a negative quarter. Q2 is that big dip where the economy fell by 20% in a quarter. Then restrictions were eased and the economy bounced back very sharply. And you can see that the economy in the third quarter grew by a staggering 15%. So you've had 2 record-breaking quarters back to back. Now, that to me is very interesting, because the lockdown that we're going through now is also very similar to the impact that you saw in Q2. So you're going to expect this to continue a bit like a heart monitor for a bit longer. And Rishi Sunak talked about this yesterday, that the worst is not behind us yet with regard to what's going on with the economy. The final quarter of last year, just to finish on 2020, is not out yet, but it's likely to be negative because of the restrictions that you had. And as I mentioned, the Q1 data this year is going to be awful again, and potentially down to 10 to 20% negative on a quarter because of the restrictions that we're going through at the moment and the lockdown environment that we're going through. That being said, when you start to look further forward, you can start to see the economy recovering. As vaccines are deployed, confidence will gradually come back. And that Q3 reading, when it was plus 15%, is extremely interesting to me as well. The UK population, the UK public, are keen to get out there as quickly as possible and have their life to return back to normal. So you can see, we didn't have a vaccine last year, but the economy bounced back very strongly. So we're expecting that the UK economy bounce back very strongly as we move through the course of this year. One of the reasons that the economy did bounce back so strongly is the savings ratio. So this chart, again, I like a long-term chart, goes all the way back to 1963. And you can see that the savings ratio in the UK has been in a range of somewhere between 5 and 15%. And then Q2 2020 happened, and you can see it spiked to 29%. Now that's off the charts, and clearly you can't go out and spend any money when you're stuck in your home. The only thing you can do is get takeaways delivered and booze delivered and buy things on Amazon. But you can see how quickly that snapped back in the third quarter, and it fell down to 15%. Now, that's likely back to the levels that it was at the end of Q2 now, and saving ratio is likely to pick up. But you can see how quickly people can return back to their normal consumption habits, which is important because the UK economy is 70% driven by consumption. You really need people out there spending money for the economy to motor. And the savings ratio being elevated still gives future ammunition to be spent through the course of 2021, which is going to be a significant positive on the economy. Now, it's just not the savings ratio that we've seen this. We've also seen an increase in mortgage repayments and early repayments. So people are paying down their debts. Banks have also talked about how loans are being paid back earlier as well. So us, the general population, are in a very healthy financial situation at the moment. You have seen unemployment start to tick up, and there's around roughly 800,000 people that have lost their jobs through the pandemic when it started in March. But the unemployment rate is still hugely below where you've seen historic crises. So again, this chart goes all the way back to 1970s, but you can see the unemployment rate topped out in the mid-80s at over 12%, 10% in the 90s, and during the financial crisis was around 8%. Now, it's likely that the unemployment rate will continue to pick up as schemes like the furlough scheme start to come off. But importantly, the unemployment rate is seen as a lagging economic indicator. As the economy is recovering, as the economy is starting to accelerate, the unemployment rate always accelerates and increases. It's only when a few months down the line, when people have got the confidence to go out and start hiring again, that you start to see the unemployment rate start to fall. And like anything, things go up a lot quicker than they come down. So the unemployment rate is always very quick to increase, but it takes a long period of time, because bull markets take a long period of time, for the economy to recover. So it may take, it's a number of years to get back to the levels that we were here back in pre-2019. So we've spent a lot of time focusing there on the UK economy. And I want to just switch now to looking at how other global markets have performed during this environment as well. So on this chart, it goes back to 2006. We've got China in this green line, which is really important because China was the first country to, where the pandemic started. So it's the first to go into this pandemic, and equally, they went into a very strict lockdown. They haven't seen a second or third wave, but they've been able to reopen the economy, and you can see that they have started to get back to this trend growth, which was started before the pandemic. Now, I have to admit, there's always a degree of skepticism when we see Chinese data, but we have to go on with the information that we're given. Now, the US is this grey line here. You can see that the financial crisis really hit the developed Western markets more than China, because it was a crisis that was centered here. And you can see that the US economy was performing very strongly up until this crisis started. But equally, you can see the expectation is that the US will start to return back to normal, and growth will start to get back into that trend at the end of next year. The UK and Europe, they structurally grow at a slower rate compared to China and the US. The US grows annually around 3%, whereas China, well, they're targeting anywhere between 6 and 7%. Well, you can see that the UK and Europe was more severely hit during the pandemic. But equally, the snapback here in the third quarter was also significantly quicker. And you can see that that's expected to carry on through the course of 2021. Now, this just puts all of that information together, and you can see the global economic growth rate going all the way back to 1985, so 35 years of data. And on average, the global economy is growing somewhere between 2 and 3%. The exception being a financial crisis. But you can see how deep the recession is going to be in 2020. But equally, look where the forecast is for 2021. So the forecast for 2021 is this is going to be a record-breaking year for global growth. I'll say that again. This is going to be a record-breaking year for global growth. And it's forecast to be very strong. Now, that is very much in our expectations as well. As people can start to return back to normality because of the vaccine, then people are going to go out and going to be going out for more restaurants, going out for drinks with their friends, going on more holidays. There's significant pent-up demand which is coming through, and that's not just going to happen in the UK. This is a global impact as well. So just to summarise, 2020 was clearly a very tough year for us all, and economic growth in the UK collapsed. Sorry, it's not coming through. It's all going to come through at once now, isn't it? There we go. We are likely in recession at the moment. Q4 2020 will be a contraction, and the lockdown environment that we're going through now will also mean that the economy is contracted. You have seen significant support from governments and central banks to stimulate their economies during this tough time. It's likely that will continue as the economy is starting to emerge from this. Vaccines are key. As vaccines accelerate, restrictions will lift, and the economy is likely to bounce back sharply as well. Don't be surprised if unemployment continues to pick up this year, but that is always the case whenever we see a recessionary environment. Global growth is performing very strongly, and 2021, as I've mentioned a few times, is likely to be very strong. China and the US are also performing very strongly compared to the UK. So that's important when you're thinking from a stock market perspective. You are seeing China sort of back to normal now, which is driving significant growth already to global markets. Now, just going to pause there, and I'm just going to touch on markets now, and stock markets and bond markets particularly. Now, this can often feel a very strange time to be an investor. Stock markets have got a habit of looking through short-term noise to better, prosperous times coming. So recessionary environments are actually one of the best periods to be invested, because the fact that you're in a recession, the stock market is looking through the current environment, the economy recovering and coming out of recession. And that's been noticed over the last few months. So November was one of the strongest days for the FTSE 100 in 35 years. December was positive again because you had the Brexit developments that came through. And January, despite the fact that we are in a very strict restriction environment, has also started very strongly as well. which is very interesting. Restrictions are going up, but the stock market's going up at the same time. And this was also witnessed last year, the 23rd of March, when Boris Johnson announced that we will be going into lockdown, was actually the low of the stock market, because the stock market had already moved in anticipation and fallen significantly up to that date, but then started to rally on the anticipation that the economy started to recover. So it's very important for us, and when you're thinking about this as well, to separate with what's going on in the economy right now and think about what's going on going forward. This isn't just a phenomenon of what's going on in the current environment. The UK stock market bottomed in March 2009, but it wasn't until the end of December 2009 when the economy actually recovered. So there's always this lag. What's key to being an investor this year, though, is markets are rallying in anticipation of events. So what you really need to see is the earnings recovery coming through and justifying the valuations that are being placed upon companies as well. So just anecdotally before we jump on and talk about different markets. Sorry, it's going a bit slow for me today. A bit of a delay. So while that's loading, I'll just touch on, here we go, on the central bank response. So interest rates in the UK are at a 325-year low. As well as interest rates being low, we have restarted quantitative easing. Quantitative easing is the purchases of government bonds by the central bank. That pushes bond yields down. Those investors that are holding their government bonds take slightly more risk, and they go and buy corporate bonds. Corporate bond investors, that means that the yields are suppressed on corporate bonds as well. So it's there to try and stimulate activity and support asset markets. However, importantly, what are the impacts of that, and what's the likely impact going forward? Well, because of the fragile state of the economy, it's likely that interest rates are going to be low for the next couple of years, few years at least. And the Bank of England and Federal Reserve have said something similar to that effect. Expect interest rates to be low for the next few years. And that has significant impacts if you hold cash. So this is just backward looking when interest rates were as high as the giant number of 0.75%. So you can see here that money in the bank over a 10-year period, because interest rates have been so low, has only earned you 636 for £10,000 invested at the beginning of that period. Whereas inflation is clearly running significantly higher than that. And inflation over the last 10 years really hasn't been running away. Inflation has been running at kind of a 2 or 3%, which is in line with the Bank of England target. But you can see that the powerful impact of compounding that annual rate has on your real worth. And you've delivered a significant loss in real terms from holding cash in the bank. Now, as I said, looking forward, this impact is going to be even greater. Interest rates are low. They're likely to be low for a long time. And despite inflation being low at the moment, it is expected to be bounce back and be higher over the course of the next few years. So really, you need to, if you do have cash being hoarded away, it's eroding value slowly over time, and it's having a significant impact the longer that you have that in the bank. That's also been highlighted by National Savings Investments, which cut their rates towards the end of last year to practically zero as well. So what do you do with that money? Now, on the left-hand side here, this shows valuations at current levels compared to where they were at the last 15 years. So the higher the number, the higher the percentage, it means the more expensive the asset class is. So on the left here, I've just got a number of government bonds. Now, government bonds, as you can see from this chart, whether it be in the US, the UK, Italy, or German bonds, you've actually seen some government bonds anecdotally go negative, which is completely bizarre. That means that you're investing with someone and you're paying for the privilege to be investing with them. But that's by the by. But they're the most expensive they've been for 15 years because you've had quantitative easing, which is the purchase of these assets. So for us as investors, we're looking at an asset class that looks very expensive. The yield on a UK government bond is positive, which is something to be said nowadays, but it's really only kind of 0.5%. Now, if you take into account fees and inflation, you're going to deliver a negative return. So it's very difficult for us to justify holding these type of assets when they are so expensive. Over to the corporate bond market, it's a little bit more value here, but it's still slightly expensive when you're looking at corporate bonds. So that means you're investing with Tesco's or Marks and Spencer's, for example. We can also buy high yield and emerging market debt, which is actually quite attractive, and we do have some allocations to this area at the moment. The orange bars here just look at the different equity markets. The US has performed phenomenally well over the last few years. It is already ahead of the pre-pandemic levels. So despite the fact that the US has gone through a very serious pandemic, the equity market has looked through that and it's trading back to some more expensive levels. But the purpose of showing this chart is showing this very sad little bar here. That's the UK equity market. Now, as I said right at the beginning, Brexit has been going on for 4.5 years, and it has led to a discount of UK assets. So for us as investors, we're looking at this and thinking, well, that is now behind us. And looking forward, it's not going to happen in 2021. It's going to take a long time period for this discount to unwrap. But we think the UK equity market actually offers good value to investors at the moment. And the UK market is still significantly below the pre-pandemic highs. We have had, as I mentioned, a very good November, December and January, but we're still significantly cheaper than where we were before coming into this. So for us, the UK equity market still looks good value. Japan and emerging markets also look good value here, as does Europe. Now, it's not just the UK equity market that looks cheap. This other sad little chart over here is currencies. And you can see there that sterling is also looking very cheap versus global peers as well. So for us investing in the UK also by default means that we have more assets in sterling. And that means that we've taken profits and done well from our overseas currency positions. So when you go all the way back to 2007, when £1 was getting you $2, and today it's getting you 135. Now it did hit a low in March of last year, and sterling has recovered over the course of last year. So sterling has already started to recover, but it's still nowhere near the levels that we saw kind of going back a number of years. So this is just to give you an idea of how we see the world when we're investing. Now, again, we as individuals have a tendency to focus in on the short term. But when you're investing, you're not investing for a period of 1 month, 3 months, or this lockdown environment. You're thinking, well, how long is it till I retire? So for me, that's 20, 30 years. So I'm investing for a 20, 30 year time period. And this chart just goes to show how long a bull market can last. So the lines in red above the line just show how long the bull market was. And the numbers here, the percentages, show how strong the bull market has been as well. On the opposite side of that is bear years, and going through a bear market environment. You can see that bear markets tend to be significantly shorter than bull markets. In fact, the bear market that we went in 2020 was 1 month short, 1 month long. So it's one of the shortest bear markets that we've ever seen. Black Monday was one of the other periods that you can see it down here in the 1980s. So it's a significant fall in a very short period of time. But we started this new bull market in March of last year. So we're already 9 months into a new bull market. But look how long a bull market can last. On average, it's 8 years. So for us, looking forward, we're very positive on being invested at the moment, because we don't think it'll be an average. There's no such thing as an average here or average bull market. But the chances are that this could go on for another 7 years or so. So we're very positive about being invested. Another really important point is very early on in the bull market, when the economy's in recession, tends to be the best time to be invested, because you're getting a snapback and a bounce back from very low levels. And that's exactly what we've seen this time round as well, that the equity market bounce back has been very strong. We think that could continue as 2021 unfolds. So in summary, on this chart, think longer term, don't focus in on the short term too much. The stock market is already in a new bull market, and this could continue for a number of years yet to come. What drives that bull market is the next important question. I mentioned earlier how well the US has done, and that has been predominantly driven by technology. Now, we're all doing this on Zoom today, but the amount that we use technology has increased significantly over the course of the last year. And that impacts lots of different levels. That's not just software, that's security systems, etc. That's hardware. There's been significant investment in technology. And we have been long-term bulls of technology for a number of years, and we still like the trend long term. A recession just tends to accelerate and bring forward a lot of the investment, particularly in technology, that would have happened over the years to come. And technology is not going to slow down. It's going to continue to do very well. But the reality is that's already done very well. So this is the NASDAQ index, and it's increased by a staggering 44% in a year, which has left the technology sector looking quite expensive. Now for us, so on the right hand side, that's just the PE, so the price divided by the earnings, which shows how the higher the line goes, the more expensive the chart goes. So you can see, technology does fit into this growth type category, which is trading a lot more expensive. Down here, you can see that value ratings in stocks. Value stocks would be things like oil and gas, banks, things that people haven't really liked or wanted to talk about for a number of years, are actually looking very cheap compared to the technology-related peers. So for us, we're actually targeting more of our money in this part of the market at the moment and saying thank you very much for all of the growth that you delivered in 2020, but going forward, we think the economy is going to get back to normality over the course of 2021, and we want to take advantage and invest in some cheaper stocks. So I don't want to go through individual companies, but EasyJet's probably a very good example. It's a good quality business, which has been impacted by something that's out of its control. And we want to take advantage of that and invest at a lower level, and expecting that over the next few years, the company can recover. They'll take market share because some of their competitors have come under stress times during the pandemic. And they have a very strong balance sheet, so they can withstand the next few months, but then can prosper as the economy starts to open up. And that's very much what we're thinking about at the moment. It's saying thank you to Zoom, thank you to Facebook, you've done very well, but let's look for some cheaper stocks which can deliver the growth going forward. And then just on the left-hand side of this chart as well, this is US market, particularly because the US data is very good on this. You can see that quality does very well in a recession, in the early part of a recession. People are looking for security of their investments. They're looking to make sure that they're returned. But after the recession, that people don't focus on quality as much. And that's exactly what you started to see in November when the vaccine news came through, that people are starting to realize, well, these businesses might not go bust. They might survive, and therefore they start to look more attractive from a valuation perspective. So what are our key investment themes as we sit here today? As I mentioned, equity markets look well supported at the moment as economic growth rebounds. We think that's going to accelerate through the course of 2021 and next year as well. Bull markets can take a very long period of time, and we're in very early days of this bull market. That being said, we fully understand that it feels pretty uncomfortable to be investing right now, but that's what we're paid to do. We're paid to make the difficult decisions for our clients. The UK equity market, the sterling, is unloved. It's not going to go away overnight, but gradually over the next few years, we think sterling can start to recover, and the UK equity market can bounce back from these cheaper valuations. And that Brexit discount I mentioned earlier starts to be eroded gradually over time. 2020 was all about technology. That's why the US equity market, one of the main reasons the US equity market was very strong. Our view is that the drivers to stock market performance this year are not going to be those themes. It's going to be going to be banks, it's going to be oil and gas. Miners have already started the year very strongly. It's all retailers, property, for example, they can bounce back from the lows that they saw in 2020, which are going to be the key drivers to returns this year. Now, that being said, it's important that we understand the environment we're in, but also the longer term trends that have been in place for a number of years. Retailers are still going to be under pressure from Amazon. And if you're not embracing online now, I don't know when you ever are going to do, but if that's going to cause stresses on businesses as well. And that has knock-on impacts to the property market. So we're not positive on all areas. The property market could bounce in the short term because it is very depressed levels, but long term we do have some structural concerns there as well. There's also the big unknown of how people return to the office. I think we're all a little bit fed up of being at home and not getting that change of scenery on a daily basis, but do people return back to the offices is still a question that we don't know at the moment. So there's areas that we are avoiding and we're not fully invested in at the moment. We very much have a focus in on quality. We're not just looking for the companies that are priced for bankruptcy that can bounce very strongly in this environment. Central banks, they've already fired all their bullets. Interest rates are already at multi-year lows, so it's very difficult for central bankers to stimulate their economy. There has been talk of the Bank of England taking interest rates negative. That seems to have gone quiet, and I think if you were going to see that, you'd be seeing it around now, because this is going to be the darkest time for the economy. So what do you do in that environment to stimulate the economy? Well, you're relying on fiscal spending. You've seen this in the US already in terms of extra amounts going into people's paychecks. But another way of doing it is by hitting infrastructure and really investing into infrastructure projects to stimulate the economy. That can have a trickle-down impact as well. So that can have a significant impact on the economy as well. So that it's likely that that'll come through. That's already been talked about in the US and Europe as well, and it's likely that you'll see more even green energy coming from the back of this as well. So there are a couple of themes there that we're playing with in our portfolios. We're not negative on bonds. We're not negative on government bonds. It's just very difficult to see how you can deliver positive returns over the next 5-10 years from these asset classes with interest rates already being so low and so much quantitative easing already in the system. That being said, as I mentioned earlier, we don't expect interest rates to be skyrocketing back to the heavy heights of 0.75% any day soon. So that's going to keep fixed income asset classes well supported at low levels. So for us, we manage multi-asset diversified portfolios. We don't just invest in the equity market. That leaves us a bit of a challenge. So the way that we've solved that issue is by looking to more alternatives to support our portfolios, whether that be physical gold, whether that be hedge fund type products. That's what we're looking for to deliver the stability within portfolios and protect in those times of stress that inevitably will come in the future as they have done in the past. So just in conclusion on everything then, 2020 was a year where global growth, UK growth really collapsed, but it's in time to look forward, and 2021, despite the environment that we're in, is going to be a very strong year for economic rebound, and that's going to be driven predominantly in the second half of the year as the vaccine rollout continues and restrictions are eased. Don't be surprised and don't be concerned if the unemployment rate does continue to pick up. That is expected, and it's expected by the Bank of England, and it happens every time there's a slowdown in the economy. One of the most important points I really want to hone in on at the moment is holding cash. The impact inflation on over the long term can have a significant impact on your wealth. We are still seeing a lot of investment opportunities. Others will be as well. Please think, if you do have a significant amount in cash, about doing something with it, because it's not going to generate any returns for you. And in real terms, after the impact of inflation, you're actually going to lose value of your purchasing power. the US market, technology was the saving grace in 2020. But is it time for the UK? Is it time for value-oriented stocks to pick up and start to do better? We think so. We think that the drivers to returns this year, as I mentioned, will be different to the drivers of return last year. And the UK, you're buying at a cheap valuation, so you're already buying at a discount. So that's all from me. Officially, we do have some time for questions, kind of 15, 20 minutes or so. So I'll just stop sharing. And if anyone wants to come and mute, or Simon, if we did have any questions along the way, then happy to answer any of those now.
Yeah, okay. I will stop recording at this point.